look at how the premiums are shaping up in that F&O segment. Let's quickly look at how those numbers are shaping up. There you go. So you're seeing a 10% spike in the open interest, as you can see on the Nifty 50. This is June futures now that we're looking at. In terms of the monthly expiry, likely next week, and therefore we're looking at the June data. But you're seeing that bit of a spike. Let's also look at how the Nifty Bank futures seem to be trading in terms of the premium. There you go. There too, you're seeing a bit of a spike. So positive cues on both of those. In fact, the Nifty Bank is doing very well for itself in trade today as well. Let's look at how the open interest is shaping up. Okay, so there you go. That's how the Nifty Bank futures are looking in terms of there's been some bit of short covering on HDFC Bank, and that's what's led to the kind of spike on the stock price today. ICICI too seeing a long build up though. Axis also seeing some bit of long build up. Bank of Baroda, Bandhan Bank are just some of the others which are seeing long build ups, including a Kotak. Kotak also seeing long build up. Short covering playing out. IndusInd Bank, SBI, Bank of India are just some of the other short covering candidates on the Nifty Bank Index. Let's look at the levels to watch out for. And there is a call, there's an increase with regard to the open interest for call writing, which is happening at 23,700. So really that's where some of the resistance is building up. Even though there's some bit of support coming up only at 23,800 levels, that's of course the open interest distribution net. The last graph was the open interest change, which was playing out intraday. But the open interest distribution, there's a huge position which continues to sit at 24,000, where call writers are sitting at the 24K mark. So there's a resistance playing out there, and the 23,700 mark is where the resistance actually currently plays out. Support levels, well, 23,500 is one of those support levels that we're looking out for, and if we likely breach that, that could be problematic. But that's currently what we're looking at in terms of data. Some of the futures gainers in front of you: Dixon Tech, some short covering playing out there. Keynes Tech, Adani Energy, there's also been a block deal, and there's some short covering which is playing out over there. In terms of other gainers, or rather future losers, there you go. Max Health is one of those where there's a short build up. Paytm and Aurobindo Pharma seeing a long unwinding. Paytm seeing a short build up. Again, there's been a block deal there as well. 4% lower on that stock. Aurobindo Pharma, there's a long unwinding which is happening. Open interest gainers, there's a short build up on LTI Mindtree, Max Health, as well as Muthoot Finance. And there is open interest losers as well. And on that count, there'll be some bit of short covering which is playing out on a Force Motors, a BSE. There's long unwinding happening. And Amber Enterprises also, there's some bit of long unwinding. Aisha.
Absolutely. That's the picture on the overall market. But let's switch to India's macro, because the resilience there is being put to test as rising oil prices, escalating West Asia tensions are threatening to shake its economic cushion. So from growth and inflation to the rupee, multiple pressure points are emerging at once. And the big question now is, can India weather the oil storm and navigate this uncertainty without losing momentum? I spoke with Samiran Chakrabarty, and here's what he had to tell me. Here's an excerpt, in fact, of my conversation with him. The other big headwind, other than oil prices and an elongated war, is the currency, Samiran. Now, like we were discussing earlier, two camps. One believes that the market should find its own rate and the rupee will settle down wherever it has to. We're seeing some estimates even talk about 100 to the dollar right now. What is it that should be done right now? What tools does the central bank have to try and resurrect or stall this fall that you're seeing on the currency?
So if you take a step back, the problem which predates the war is the lack of capital inflows, or rather outflows.
Yes.
The war has complicated matters by increasing the current account deficit. Like for us, we were pre-war thinking current account to be 0.6% of GDP. Now we are thinking that number to be 2% of GDP. So it's a significant impact that has come, which has complicated the policy challenge on the currency front. Let's face it that if our forecast is correct that even FY27 will be a substantial BOP deficit year, then this will be the third consecutive years of BOP deficit, which we have never seen in the past. So in a BOP deficit year for the central bank to control the currency is that much more difficult. That's agreed. And that's where some people are suggesting that just let the currency go and let that self-equilibrating mechanism play. But unfortunately, in Indian context, there are certain challenges. One of the challenges is that a large part of our exports, in fact, majority of our exports are in the form of re-exports. We import crude oil, export refined products. We import yarn, export textiles. We import gold, export gems and jewelry. In those cases, the exchange rate just becomes a pass-through. So you don't actually see the benefit of exchange rate depreciation on exports as much. Similarly, on investment side, we rarely see that investments flow in just because the currency is cheaper. Investments flow in only when they think the underlying asset is going to deliver returns, not just because of the currency part. In fact, currency depreciation can create an environment of risk rather than return in that sense. So that's where if there is this perception of continuous depreciation without any support from the policymakers, then that depreciation begets depreciation and this becomes a slippery slope. And that's where I think that some policy intervention would happen at some point of time, both towards encouraging capital inflow as well as to some extent discouraging capital outflow, because that will have a more immediate effect. Encouraging capital inflows, unfortunately, takes time to work through the system. So it's hard to put numbers here that exactly where this rupee is going to settle down. But it is, at least I belong to the camp where I cannot suggest that that allow depreciation in an unlimited way and hope for the markets to find a self-correcting mechanism. I don't think it works in the Indian context.
But how do you arrest the BOP situation? I mean, what tools would the government have to try and, buffer up the CAD? Because you don't have flows financing it right now.
Yeah, I mean, per se, the 2% of GDP current account deficit is not too large.
Sure.
In fact, some people will argue that a country at India's stage of development should actually run a slightly bigger current account. So we can't have too many very forceful measures to reduce the CAD, because that could have its own consequences on growth, etc. So the government has started doing it through the gold and silver route, which typically has been thought of as more unproductive in nature. We can delay those purchases for a few months. Now we are moving into the electronics product categories. The government has announced it for AC compressors. You could see more of that coming. The other important element, which historically the government has tried tweaking duties, is edible oils. We've seen those duties move up and down depending upon conditions. So that can be another area. I'm definitely not in the camp of trying to tweak with the LRS limits. In my view, that will not work as much because the LRS value is not, outflow value is not increasing year after year. It's been kind of flattish. So, and most of it is because of very essential things like travel and education. So there's not too much of a speculative element in it. So the problem really is that what to do with the capital account, because that's what predates the crisis. So we have to think of innovative solutions towards that. One sort of appreciation from this 3-month war period is that the bond inflows have been stickier than the equity inflows. And that's where we've been suggesting that getting India into more global bond indices could be one way of getting more sticky inflow into the country. And lastly, I think the market reaction, the INR move, vis-a-vis the actual BOP deficit has been a bit too much. So there is obviously, quote unquote, this speculative element into markets as well. And that's where some of the measures could be just to ensure that this speculation is limited. We've seen some of that measures come in end of March. We could see a bit more of that also if the policymakers feel that this effect is again becoming stronger.
You know, Samiran, to the point that you were making about money chasing growth, is it an India problem right now, or is it more a relative problem? If I'm getting higher dollar returns and better returns in countries like Taiwan, Korea, and of course US, therefore the money is moving to those countries.
Absolutely. I mean, that's quite possible that for a while, this narrative was there that India is benefiting from the TINA factor, that some of the countries, large countries, were almost called uninvestable. And for a couple of years, we saw massive amount of inflows into the country. But we should not also underestimate that in those years, India per se had to offer a very attractive narrative also. We're doing a lot of public capex, so that was a narrative. We're doing the PLI schemes, and that China plus one narrative was there. So similarly, there were quite a few ones which investors were noticing. Today, I think what we require is another narrative, which will be attractive for investors. I know that there is that global AI narrative, semiconductor, defense. Different countries are playing these narratives and they're getting capital because of that. Whereas for us, we have a good macro, but that is something which is already in the price. So there's nothing new as such there. So we need to put that new narrative into play. And I firmly believe that that's how we'll be able to attract capital.
But tell me, what do you think that in a scenario like this, where I think the one word that can describe the state that we live in is just uncertainty. There is no word to describe it beyond this. What can the RBI do? Because many fear that, now you're going to see a rate hike come in, or at least the narrative may change. You think that's where we're headed?
So if you go to economic theory, the historical kind of wisdom has been that in uncertain times, you have to move slowly.
You hold fire.
You hold fire, you see how things are progressing and then take action. Some people use this Chinese proverb to say that feel the stones while crossing the river. So that has been the standard practice. However, the change that I'm observing is that earlier these supply side shocks, these uncertain environment would probably come, once in a decade. Now we have got like 5 such shocks in 6 years. So when you have these repeated supply side shocks, the question is that can monetary policy really be very patient, or would it need to act? I'm not for a second suggesting that in the June meeting itself RBI will have to act, but it's just that looking through these supply side shocks is becoming that much more difficult for the central bank since the supply side shocks are becoming recurrent.
Interesting. So you don't think RBI will move as soon as June?
It looks unlikely to me because the last inflation print still is below their medium-term target. It's at 3.5, medium-term target is 4. So there is enough elbow room there. In fact, the RBI has now started focusing a bit more on the core inflation. They're giving the core inflation forecast also. So these energy shocks and the food price shock, they can, in a sense, look through those shocks and only focus on that core inflation number. So our sense is that the core inflation has to stay above 4.5 on a persistent basis for them to be worried about or utilizing the demand management tool that is the interest rate. Because otherwise, if it is just an energy shock or a food price shock, the interest rate tool is a very blunt tool to use.
To the point that you were earlier making about the flight of capital, and what is it that you have to say about, not just capex, but also about private capital moving out of the country? And again, for reasons which we discussed, because, there are better investable opportunities outside India right now. You think that can be curtailed in some form?
So we have seen a lot of liberalization over the years on that front, particularly after COVID. And clearly, the increase in the outward direct investment from about $14 billion to almost $27 billion now is a very big jump. So maybe there is some merit in considering what to do with it. It requires a more nuanced analysis to figure out how much of this ODI is for genuine purposes versus how much could be in the nature of what we loosely call capital flight. Without that granular distinction, it's difficult to think of policy measures. But in a crisis situation, a lot of policy tools are brought out, which are not advisable in normal circumstances. So one of them could simply be to stagger or defer these outflows for a few months. Not really stop them, but it's just going through a relatively more staggered phase.
Welcome back. And, Page Industries is a stock which has been in focus since the morning. There was a spike in the stock price. We've seen a bit of a cool off from that point, of course. 4.5% higher on that stock came straight off. Now just about 1% higher. But nonetheless, the commentary was extremely strong. The management says consumer demand is expected to remain strong all through FY27. Listen into a slice of the conversation we have.
Okay. Over the years, we have followed a calibrated and consistent approach towards retail expansion. Our focus has not been on numbers, but on the productivity and effectiveness of our expansion. We want productive expansion. So this is going to be our strategy for year 27 as well. And if you see historically, we have added around 150 to 200 EBOs or exclusive brand stores across the country. I think year 27 we will be looking at somewhere around 150 to 200 stores. Our focus continues to be on strengthening the market penetration while maintaining a healthy store economics and, most importantly, great consumer experience standards. We want to keep elevating the consumer experience. Coming to a question regarding Tier 2 and Tier 3 markets, they're increasingly playing an important role in our growth journey. With young aspirational population and a growing economy, your target audience or the target consumer group is spread across all tiers of the country. And it's no longer restricted to metros or Tier 1. And Jockey being an affordable premium brand, not a luxury or a premium brand, it has relevance in all tiers. So in that sense, Tier 2 and Tier 3 markets play a significant or a very important role in our journey.
Okay, so that's the management of Page Industries, but Varun Beverages is the other one which is in focus after extending its exclusive bottling agreement with PepsiCo in India by another 10 years. This extends it till 2049. The revised pact also removes earlier restrictions that limited Varun Beverages to PepsiCo-related operations. This opens the door for expansion into new businesses, including alcoholic beverages. Staying here with all of the details on that.
Yeah, so Varun Beverages is in focus on the back of a very positive update for the company because Varun Beverages and PepsiCo and its affiliates have entered into a revised exclusive bottling agreement, that's EBA, so that's exclusive bottling appointment and trademark license agreement for India yesterday. So if you take a look at what this brings in for Varun and why this is a positive. The EBA, that's the exclusive bottling appointment, has been extended to 30 April 2049 from 30th April 2039. So that's an extension of their partnership for another 10 years, starting 39, so all the way up to 2049. And earlier, this EBA restricted Varun Beverages from carrying out any business outside of PepsiCo operations. So Varun Beverages acted as a special purpose vehicle only and exclusively for PepsiCo. This requirement has now been deleted in the revised EBA, and this allows Varun Beverages to pursue business opportunities outside PepsiCo related operations. Now, why is this such a big deal for Varun Beverages? Because remember, Varun Beverages has revamped its entire business model and it continues to expand aggressively across domestic and international markets. They've also recently acquired Crickley Dairy and Twiza operations in Africa, and Bank of America believes that Twiza acquisition in South Africa could add another 6% to Varun Beverages volumes, 4% to its revenue and 3% to its EBITDA going ahead. So this deletion of the clause where it only has to be PepsiCo's exclusive vehicle has now opened the door further for Varun Beverages. They've also revealed plans earlier in the year to enter the broader alcoholic beverages sector, and they're also eyeing an exclusive distribution agreement with Carlsberg breweries in Africa. So this opens the door for a lot of other opportunities. Just quickly taking you through what the Varun Beverages PepsiCo history has looked like. Remember, Varun Beverages is PepsiCo's biggest bottling partner outside of the US. Late 1980s, the bottling operations began, which were then in 1995 consolidated under the Varun Beverages brand, and in 2019 was a big step up for Varun Beverages because PepsiCo transferred its company-owned bottling operations in South and West India entirely to Varun Beverages. Under this agreement, Varun Beverages now holds PepsiCo franchise rights across 27 Indian states and internationally in countries like Nepal, Sri Lanka, Morocco, Zambia, Zimbabwe, South Africa and the Democratic Republic of Congo. It also handles PepsiCo's distribution rights in certain parts of Africa. So this is why this is such a big positive for Varun Beverages. And just to remind you, it's the latest numbers of Varun Beverages for their Q1 CY26 have been very strong. So that's the take on Varun Beverages, and this is why this is such a big positive.
Okay, thank you so much for that, Sneh. The auto pack and Happy Forgings, GMM Pfaudler will be in focus on the back of their earnings, or rather is in focus on back of the numbers that they've disclosed. Good numbers from Happy Forgings, but GMM Pfaudler slightly short. Are we here with the fine print?
Let's talk about two stocks that came out with its earnings. Starting from a poor set of results, we have GMM Pfaudler, which came out with a mixed to poor set of earnings. Since the revenue and PAT is in line, but the EBITDA margin has contracted sharply by almost 4% sequentially. This is due to the West Asia crisis. The management guides that they are targeting for an EBITDA margin of 15% over the medium term. They are also planning for some debt restructuring with over $20 million prepayment planned. They have undertaken some cost restructuring in Europe, and their Poland plant will serve as a low-cost manufacturing hub. The order inflow is up 20% for them, and the open order backlog grew by 34%, which gives them a strong revenue visibility over FY27. The new group CEO and the deputy CFO will lead the transformation at GMM Pfaudler. Talking about a strong set of earnings, let's move on to Happy Forgings, which is a beat on all the fronts. The revenue has grown by 20%, EBITDA by 30%, and the PAT is up by 23%. Their capacity expansion will help support their growth momentum, and their export pipeline is also seen to be very strong. The margin impact is very minimal since they have pass-through of cost agreements with its customers. They can see strong traction in their CV and PV segments, and the demand for the tractors is also seen to be very healthy. The strong cash generation they are able to do is help supporting their expansion ambitions. And the volume and realizations for Q4 FY26 compared to Q4 FY25, the volume is up 20%, but the realizations remain largely flat.
Okay, thank you so much for that, Avi. In fact, Honasa is the other stock which is in focus. Stock is flying in trade. Blockbuster fourth quarter beat estimates across revenue, EBITDA and profitability, and demand momentum accelerated sharply across brands. Sneh here with the highlights from that one.
Well, absolutely. Let's talk about Honasa Consumer's Q4, and it's been a very strong quarter for them yet again. It's a beat on revenue, EBITDA, PAT, as well as the EBITDA margins compared to what the street was estimating. Just to take you through those numbers, revenue was up 23%. The net profit has seen a jump of about 162%. So that's like more than double, slightly more than double on a year-on-year basis. The EBITDA margins have also improved by about 665 bips to 11.7% compared to 5.1%. What the street is also liking is Honasa Consumer has declared its maiden interim dividend at 3 rupees per share, and the commentary from the management is that they have declared this dividend and that reflects the strength and the confidence that they have in the company going ahead. If you take a look at the quarter four highlights, this was of course the highest ever quarterly revenue as well as EBITDA for Honasa Consumer. The underlying volume growth has come in at 30%, which is a very strong beat versus the street expectations of just 18%. So it's been no doubt a very good quarter for them. There has been a change in settlement by the Flipkart group, but there has not been any impact on the bottom line is what the company has said. Focus categories have grown at 35% plus. Mama Earth has seen growth in teens, and the younger brands, that's Dermaco, Aqualogica, Dr. Shades, Be Blunt, Stays as well as Reginald Men, they have grown at 40% plus. Reginald Men, which is their most recent acquisition, this was the first full quarter of operations and the ARR has already hit 100 crore plus. In terms of their channel growth, e-commerce, general trade and modern trade all continue to grow very well. So all in all, it's been a very good quarter for Honasa Consumer and 30% volume growth looking really strong for Honasa Consumer in quarter four.
Okay, thank you so much for that, Snehi. And in fact, switching focus to Tata Sons, the chairman N. Chandrasekaran and Noel Tata are set to hold key discussions ahead of next week's Tata Sons board meeting, with governance, strategy and listing related issues likely to dominate the agenda. Ankur joins in with the details.
Yes, sources say that Tata Sons board meeting is set to happen next week, and the key agenda is likely to be the listing of Tata Sons. Remember, this has been a pending issue for very long. September 2025 was the deadline as far as the list of NBFCs is concerned, and after the deadline, the company had requested for a waiver from Reserve Bank of India to deregister itself as CIC NBFC from the list of NBFCs, but we do not know yet that whether or not regulator had given that exemption, because in the list of last list of the upper layer NBFCs, Tata Sons was a key company in that, and therefore it is interesting to see how Tata Sons wants to move ahead as far as listing is concerned, and for that we understand there is going to be a discussion in the board meeting which is set to happen. Apart from that, Noel Tata is likely to raise the concerns around Air India losses and Tata Digital performance in the board meeting, and remember, this was a point which was raised even in the last meeting of Tata Sons, and we understand that there is likely to be a presentation which may be made by N. Chandrasekaran to the board regarding the performance of the group companies. But all in all, the meeting is set to happen next week, and it will be interesting to see what decision Tata Sons takes, especially on listing.
Okay, thank you so much, Ankur, for that. Completely timed out on this edition of First Trades. Thank you so much for tuning in. Stay with us here on ET Now. More action to follow.
Hi there, good morning. You're watching Midcap Masala on ET Now. I am Snehisha, and today on the show is with me is my colleague Ashesha Advaryu. And this is a show where we are going to be throwing the spotlight on the broader end of the market, giving you a sense of what's happening within the mid-cap and the small-cap end, and also some of the managements from that end of the market we'll be interacting with on the back of news and updates and earnings. The Nifty looking solid right now, gains of about 0.5%, but the broader end is absolutely flat and tepid as we speak. Before we take you through what the market moves are looking like, here are some of the top performers from the broader end. And let's start by talking about Honasa Consumer. Very strong set of numbers coming in. Honasa Consumer has gained about 8% as we speak on strong quarter four. The company has reported its highest ever quarterly revenue and EBITDA with underlying volume growth at 30%, which remember is much ahead of the street expectations of 18%. Revenue has come in at over 650 crore rupees, which is up 23% on a year-on-year basis, with EBITDA margins expanding to 11.7 from 5.1% on a year-on-year basis. Tech gains 3.5% on strong Q4. Revenue at over 1,400 crore rupees implies an increase of 22% YOY, aided by execution and strong order book. Increase in other expenses, however, dragged margins to about 11% versus 12.5% that the company reported same time last year. Order intake in fourth quarter stood at 7,500 crore rupees, and the order book now stands at over 17,200 at the end of fourth quarter. And JSW Cement, after gaining 5% yesterday, that stock is up another 6%. The management says demand in April was soft, but indicated that demand conditions started improving from May onwards. The management has also reiterated its 200 rupee per ton cost saving roadmap and expects 100 rupee per ton additional savings in FY27. Shifting focus to Central Bank of India, then the stock is declining 6% in trade. The government is offloading about 8% stakes through an offer for sale at a floor price of 31 rupees per share. The OFS is open for non-retail shareholders today, and it will open for retail shareholders on Monday. And another stock under pressure is Max Healthcare. That's down 6% today. Although revenue grew 12%, it missed street estimates. The EBITDA is up 19% and margins too have expanded to 28%, but it missed street estimates. All right, those are all the top headlines that we are tracking at this point in time. But let's put the spotlight on Bikaji Foods. This counter reported its numbers, and to understand what the outlook is for FY27, we are now joined by Mr. Manoj Verma, COO, and Rishabh Jain, CFO at Bikaji Foods, who are now joining us. Gentlemen, thank you for taking your time out and joining us here on ET Now. Mr. Jain, I would like to come to you first, and let's talk about volume growth. It was very strong at about 16% in the fourth quarter. How sustainable is this number as we head into FY27 with crude volatility still continuing to remain at play?
Thank you very much. So largely in last 6 months, we did two big campaigns, which has helped us in overall giving a good volume growth. And this year we continue to stay in momentum. And we want to grow our business at overall 15 to 16%. That's the overall target what we're taking. And from volume perspective, of course, we have seen a good price rising across all raw material and packing material. So volume growth should be around 11-12%.
Okay, and this volume growth for 11-12%, Mr. Jain, are you guiding for quarter one of FY27 or overall FY27?
Overall FY27.
Okay, understood. So that's your guidance for overall FY27. Mr. Verma, hi morning. Let's come to you. Help us understand what is the company's hedging strategy on the procurement of edible crude oil requirements. How have you been navigating the kind of inflation that we're seeing in oil prices?
So the oil prices post this war stuff has really been very volatile and moving upwards as well. And this is the heat which most of the organizations are feeling heat. What we have done is that in quarter one, we had to, taking all these price increase in consideration, we have passed these prices to the consumer to a certain extent to protect our bottom line.
Right. Mr. Jain, let me come to you and let's talk about segment-wise performance then. And ethnic snacks and family packs continue to perform very well in the fourth quarter. Which categories are seeing strongest traction currently, and how sustainable is the double-digit growth trajectory in the core snacks business in FY27?
If you allow me to answer this, if we look at in terms of our traditional snacks, which is our core, that's doing very well, and all our inputting also, if we look at in the last 6 months. So the first campaign to gain momentum in Bhujia, we did Bhujia Auto Bikaji. That was one mega campaign what we did and showed wonderful results. Then we did a special campaign for UP market, which was Kya Baat Hai, roping in Pankaj Tripathi in it, and primarily focusing on the traditional snacks. So this is a major pie of our overall business, which is close to 70%, and this would continue to help us driving growth going forward.
Okay. Mr. Verma, you did mention that you have been able to successfully pass on the hike in cost to the end user. Can you quantify what the price hikes have been in the quarter gone by? And as crude continues to stay at elevated levels, you also have laminates cost that has gone up that must have impacted your packaging costs. Talk to us about whether any more price hikes are on the cards from your end.
So we're seeing good increase in packing material as well as edible oil prices, and that's how we are passing the price in first week of April. Till now, I think we have been we have seen big hike in pricing, but it has come down a little bit. So we are comfortable with the passing of price. We are not seeing any major price rise as of now.
Okay, and Mr. Jain, what will your capacity expansion plans be? Are you looking to expand across other states and geographies?
So largely, we have set up plant across each core and focus market, and we have reasonably good capacity as of now. Thanks to PLI, we have set up plant. We have invested in completed our capex cycle last year. In this year, we don't have any major capex plan as of.
Understood. And also, we've spoken about your raw material prices. We've spoken about laminates. Talk to us about any capex plans that you have for FY27, if at all. How would it be funded, and how much would that add to your total capacity utilization?
So in FY27, we have some very small capex plan, which will be less than 100 crore rupees, and that will be funded through internal accruals. We have good, strong cash flow, which is generated from business.
Okay, and Mr. Verma, we understand that the baking business as of now is a very small part of the company. You've also approved further investment in Bikaji Bakes up to 5 crore rupees. Talk to us about what's the outlook for the baking business, and can this become a meaningful contributor to your overall top line, and if so, what would be the timeline here?
So bakery business, or the investment what companies decided to get in, is a futuristic business. So if we look at it in next couple of years, it would not add as much value. But yes, what we are looking at, it is in our strat plan. It is 2030 onwards, you will see that a substantial data would start coming in from this stuff. This business is divided into 3 parts. So one will be into premium bread. So that's one. Then second is roasteries, and third is cakes and muffin stuff. So 3 parts of this business, and this would be one of the best in class produce what we are going to get out of this plant.
Right. We do understand that raw material prices have remained very volatile over the last few quarters. You also spoke about price increases, but what could the margin trajectory look like in FY27 given price increase and the consequent passing on of the raw material price that you've spoken about?
So we want to maintain same gross margin what we're doing. That's the target what we're taking as of now. So the same gross margin what we did last year, the same what we want to continue this year also.
Okay, understood. And also talk to us about the incremental demand that you have seen on the back of GST reduction. Namkeens has been a big beneficiary of GST getting cut. A lot of your raw materials have also seen some moderation in prices on that front. Vis-a-vis that, how are you balancing your raw material costs, and how has all of this shaped up demand in Q1 as we speak?
So there's been a story of 2 halves last year. How we look at it is that pre-GST regime, new regime, and the post one. So the growth post new GST regime has been really very promising, and that speaks about consumer demand and the consumption. If we look at our growth in H1 versus H2, I think that's a testimony of what we say. And this also, the volume growth which you started off from your first question, was also one of the reasons that the benefits we passed on to the consumer. So therefore, that helped us, deliver those kind of volume growths in the last quarter what we saw.
Okay, on that note, Mr. Verma and Mr. Jain, thank you so much for your time today. Good luck for the quarters to come, and hope to be interacting with you very soon. Thank you so much.
Thank you.
Okay, viewers, so that was the management of Bikaji talking to us about their growth outlook, and 11 to 12% volume growth is what they have guided for in FY27, and also said that the margins should continue to be where they were in FY26. So sounding good on that front. Let's shift focus and get into a conversation with the management of International Gemological Institute. We've got the CFO, Mr. Ishwar Iyer, who's joined us on the show, and in fact in the studio today. Mr. Iyer, good to be speaking with you, and thank you for your time. Give us a sense of how the quarter has shaped up for you. It's been an incredibly strong quarter for IGI, and that trend has continued. Talk to us about what has worked out for you this quarter, and how has the certification segment shaped up?
Well, thanks for having me. It's always a pleasure to interact with all you guys. So thanks once again. Yeah, we've had a pretty good quarter. Q4 now for us, actually. We just moved from a 12-month to a 15-month cycle for this period, because we just moved it from Jan, December to April to March. So that's the reason you look at 15-month results versus 12 months. But in our investor deck, we also have a 15-month financial so that people get a good perspective of what's happened over the last 15 months, 2 years together. Yeah, we've had a very strong quarter driven by lab-grown diamonds and natural diamonds, and it's also lab-grown jewelry. We've seen significant capacity additions that's happening in that segment from a manufacturing standpoint. And also from a retail standpoint, there is a lot many outlets now opening up in India as well. Because just to give a context, most of those diamonds most of it gets produced in India, right? So all of that, majority of that goes to the US because the US has been the first adopter of lab-grown diamonds. The Indian consumer is probably coming to the fray. That's the reason you see a lot of investment in the retail side as well. So both from a demand standpoint as well as from a supply standpoint, we are seeing a lot of demand coming up, not only in the US, but also in other parts of Europe, in Australia, and now also in India. So I think from that standpoint, in line with whatever narrative we've been giving and whatever data points we have, I think we are at the beginning of a significant ramp up of lab-grown jewelry in India as well. So let's see how that goes, but it's obviously driven by some of the investments that's going into both manufacturing as well as retail.
Right, and we spoke to you a couple of months ago. You had come to our studio when you did that acquisition, that's the American Gemological Laboratories acquisition. How has that played out? Has the integration been completed, and how is it likely to factor into financials in the next few quarters?
Yeah, again, that's been a very important step for the company. I think it's been a strategic investment that the company's made because it offers IGI capability in gemstone certification, which we currently don't possess. And AGL is a one city operation. They're based out of New York. IGI is based out of 8-9 countries. So the marriage is to ensure that we are able to scale up AGL and leverage their brand strength because they are one of the very, very large as well as acclaimed certifiers for gemstone. From that standpoint, hopefully this marriage helps build that scalability across the globe. Yes, from an integration standpoint, work has started because we finished the acquisition on 31st Jan. So Feb and March, we had 2 months of results, which got submerged into the IGI financials, which I think is there in the narrative, which we had on the transcripts here. So around added a couple of percentage points to the revenue as well as the EBITDA growth for this quarter.
But I remember last time when we spoke to you, you also told us that you're looking to expand via some other acquisitions. So anything that is in the pipeline?
Those evaluations continue because we're pretty strong from a cash flow standpoint, and we don't have any debt on the balance sheet. So those evaluations continue. But just to conclude on the earlier point that you made, so I think that integration work is nearly more or less done. But scaling up will take time because this is a highly skilled, require a lot of people to be first gotten into the organization, trained over 6-9 months before they can be, put on the road for certification, etc. So we guess that'll going to take 2-3 quarters, but let's see how that goes.
And Mr. Iyer, we've been talking to a lot of jewelry players, especially after their Q4 earnings. And the common commentary that we're hearing is that the demand for gold jewelry has reduced, but it's studded, it's lab-grown diamonds, and it's a lot to do with diamonds now. That segment is evolving. On the back of that, how has the quantum of your inquiries shaped up in Q4?
See, if you look at our numbers, I think we have had a soft quarter as far as natural diamond jewelry is concerned. We guess that's because of the high pricing as also volatility in both gold and silver.
Sure.
I think even if it's high price, if it's not volatile, then the market settles down. But I think both of these have probably impacted the consumer demand probably. But obviously, with lab-grown diamonds, you can probably balance your budget because it's far cheaper than natural diamonds. So hopefully that combination plays out. And you can see that in our results for the quarter. I think we've grown lab-grown jewelry at over 29%. So that's again evolving. I think it's a combination of what I talked in the first point in terms of the Indian consumers coming into the fray as far as lab-grown jewelry is concerned. So this is, I think, exciting times for the industry. So let's see how that pans out.
And can you share some guidance for FY27 in terms of numbers? What kind of revenue growth, what kind of margins you're penciling in?
Yeah, I think the company is striving to deliver a 15% revenue and a 20% EBITDA growth. Let's see, so that's the end of year. So all guns blazing, at least from a capability standpoint, investment standpoint within the organization to enable us to deliver that sort of growth. So fingers crossed.
Fingers crossed indeed, but let's talk about the average pricing per report. We've seen a 4% jump on a year-on-year basis over there as well. How much more pricing power over there? And given that there is now so much demand for gemstones, you have a whole new category now that's added. How much more pricing power do you hold?
See, we've been holding our prices because there is no disputing the fact that pricing has been under pressure. And we took that pricing correction sometime in 2024. But the last 4-5 quarters, the pricing has been stable because our pricing on certification is directly dependent on the wholesale price for lab grown. So from that standpoint, the pricing has been stable. The ASP improvement of 4% is completely driven by the mix change this quarter. Okay. Because we obviously lab-grown loose stones have outgrown every other category. Absolutely. And they are a better realization versus jewelry from an ASP standpoint. So that's what has driven this ASP improvement for this quarter. It's nothing to do with pure pricing, it's all mix.
Okay, so what is the mix looking like right now, if you could spell that out for us? And more importantly, what could the gemstone contribution be to the mix in the near future?
Okay, I think at the moment we've moved our lab-grown business around 60% of the business on loose stones. Okay. It was around 55-56%. So that incremental mix change is what has driven this pricing. Gemstone is going to take some time because it's still very nascent and very small. Okay. So it's not going to significantly impact the financials. But the intent is to scale up that business because apart from the US, there is a huge amount of demand, pent-up demand actually for certification of gemstones in markets like India, in Jaipur, Thailand, Dubai, China. So we are present there, whereas AGL isn't present there. So we just need to ensure that we are able to scale up, setting up laboratories in these places, getting trained staff there. Because the skill set required for grading diamonds is very different from the skill sets for grading gemstones. So we'll have to build that capability going forward.
And is gemstones more margin accretive as compared to diamonds?
It is at the moment, yes.
What is the difference between the two?
It's at least 2 times the ASP versus what we have.
So which means if you go ahead and expand in gemstones, it is going to directly aid your margins.
That's right.
Absolutely. And any contribution to the business right now from Europe? Rather, what is the contribution? And do you think this FTA is going to bring in more certifications for you?
Yeah, see, once upon a time, Europe used to be the hub for cutting and polishing. All of that has moved to India. So what remains in Europe is the retail strength, which we have to leverage because most of the manufacturing plus the certification, the cutting and polishing, all of that has moved to India. So from that context, the power center effectively is moved from Antwerp to either Surat or Bombay. You know, so from that standpoint, yeah, the business contributes around 5-6% of our revenues, the Europe business. But yes, most of the retail continues to be there. So certification revenues are booked in India for the final demand which goes into those markets, similar to what happens in the US as well.
And what is the domestic versus export mix for the company?
We see the way we look at it is 80% of our revenues come from India. Now, while we are grading stones here in India, we don't have any estimate in terms of how much of that goes to the foreign shores. Okay. So that's again with the manufacturers and the jewelers, etc. So what we track is what comes into each of our labs. So our 80% of our revenues comes in India. Another 10% each is in the Netherlands entity, which is the geographies of Israel, Dubai, Thailand, Hong Kong, and another 10% from US and Belgium put together.
How many certification requests come from the Middle East? Any impact over there?
See, Middle East is starting to grow and it's really scale up in the last 15-18 months. So we're seeing significant build-up of business in the Middle East. So at the beginning of the onset war, etc., I think we had some challenges in the beginning. But things have settled down, actually. There haven't been too many disruptions. We'll just keep our fingers crossed there because I think the safety of our employees is paramount for us. So we've been extremely cautious in terms of how many people can come into the lab, etc. But it's been okay. I think the quarter has not been very bad from Dubai. It's continued to grow and it's double-digit growth there as well.
And if we had to picture the company 3 to 5 years down the line, where do you see the company? What will the growth roadmap be, basically?
See, as I mentioned, I think the lab-grown segment is where we are extremely strong. The natural diamond, I think globally we'll have around 20-25% share. One of the strategic imperatives for us is to build that segment on the back of the lab-grown strength that we have here in India. So 5 segments actually: lab-grown loose stones, natural diamond loose stones, lab-grown jewelry, natural diamond jewelry, and gemstones. So gemstone is the new kid on the block for us. I think these are the 5 levers of growth which have to kick in equally. But again, 15% CAGR on revenue should be doable because of the way the industry is evolving.
You know, Mr. Iyer, just out of sheer curiosity, you hear a lot of buzz when people say that lab-grown diamonds have advanced to an extent where not even certifiers are able to tell the difference between a natural and a lab-grown diamond. How true is this statement? See,
a senior gemologist working in our organization, to the blind eye, it's difficult. They can't do it. They need specific equipments, etc., to identify a natural versus a lab-grown. That's the reason we have separate certificates for natural diamond and lab-grown. So the origin of the diamond today is far more important than previously, because once upon a time it was just natural diamonds. Yeah. Now lab-grown has come into the fray. So the origin is very important. So our certification captures the origin, telling you whether it's natural diamonds or lab-grown diamonds. And then it gives the 4 Cs, which is the cut, clarity, color, and the carat weight. So I think that helps the consumers understand what they're buying.
And are margins on certification of lab-grown and natural diamonds different?
See, from an absolute number standpoint, obviously we don't track it separately because we have staff who are fungible. A grader who can do natural diamond can also do a lab-grown. And the important part of our cost structure is the employee cost.
But in terms of revenue?
But from a revenue standpoint, as I mentioned, 60% of revenues come from lab-grown. So the volume, from an ASP standpoint, the realization on natural diamond is much higher than a lab-grown. But the volumes on lab-grown overcomes that sort of dichotomy there. So from so 60% of revenues coming from there probably will translate to 60% of the EBITDA also getting contributed by lab-grown.
And lastly, just again out of curiosity, based on the kind of certification requests that you're getting for lab-grown, would you say that the adoption and penetration of lab-grown has increased not only globally but also in India?
See, the important aspect here from a certification standpoint is the certificate provides the commercial value for trade to happen amongst the various players in the value chain. So starting from the grower, then the jeweler, the retailer, etc. The 4 Cs, the origin, all of that enables to determine the value of the diamond. So from that standpoint, certification is very, very, very important. And coupled with the fact, obviously, we are a third-party independent certifier, which just enables the cost to ensure that there is adequate maker-checker controls so that the consumer interest is protected. So from that standpoint, we have seen, obviously, an increase in, because as consumer awareness builds up, I think that when they walk into the shop, they will probably ask for a certificate. And if they ask for IGI certificate, nothing like it.
Absolutely.
And that's the reason we're also embarking on a brand campaign, etc., because I don't know whether you guys noticed it, but last year we had the association with the Women's World Cup. Now we are tied up with Gujarat Titans. We are a co-sponsor there.
Yes.
So all of that work is also going on just to ensure that the consumer is aware. Yeah, I think just create that awareness.
Okay, on that note, Mr. Iyer, it's been a great conversation. Thank you for coming down to the studio and thank you so much for your time today.
Pleasure as always. Thank you very much.
Thank you so much. Okay, with that, viewers, we're completely timed out on this edition of Midcap Masala. From Ashesha, me and the team that put this show together, thanks so much for tuning in. But stay on to ET Now because Buy Now, Sell Now is up next.